Hey, everybody. Thanks for joining. Welcome to Elevate Wealth Advisory's 2024 Financial Year in Review. We're excited that you're with us today. We're going to wait a few seconds just as everyone joins our webinar today to make sure everybody gets in okay. I'm Deanne Rosso, President and CEO of Elevate Wealth Advisory, and I'm happy to be your host and your moderator today. At Elevate, lifelong learning is one of our core values, and today's webinar is the year-end edition of our monthly educational webinar series. So we hope you'll join us each month as we dive into a topic that we hope you find relevant and helpful to your personal financial journey. And if you want to learn more about us or our webinars, you can visit us at elevate-wealth.com. And don't forget the dash, that's important, elevate-wealth.com. Today, I'm happy to be joined by some esteemed guests and colleagues as we recap the year 2024 and answer some of our frequently asked questions. And now that we have 2020 in hindsight view, we can think about how those things have impacted us this year and what those things may mean for 2025 and beyond. So today we have several of our Elevate team members joining us, Chuck Vickery, Clark Holt, Rob Fazekas, Dee Dee Bloom, Brian Rosso, Gary Stoller, and Preston Wilkie, and Betsy Kenyon. And while I would love to share a little bit more about each of these amazing people with you, that would definitely take more time than we have on our webinar today. So you can visit the About Us page on elevate-wealth.com to learn more about each of these fantastic team members. But I'll sum it up by saying that I'm really proud to work side by side with these wonderful folks who work so hard to serve our mission of giving our clients access to the tools and resources to confidently live their best lives. So thank you, team, and welcome as my co-moderators today. Also, if you have questions or comments to leave for our team or our guests today, you can feel free to drop those in the chat box during this webinar, and Betsy will be monitoring that today. And if time allows, we will get to answering some of your questions. But speaking to access to tools and resources, the experience that we're able to deliver to our clients is greatly enhanced by the partnership we have with Buckingham Strategic Partners. And if you're a client of Elevate, Buckingham is no stranger to you. We've enjoyed our strategic partnership with Buckingham for going on 18 years now, and they provide us with the access to tools and resources that we need to support our clients on their financial journeys. And we're happy today to be joined by Mike Osborne, Divisional Manager, and Brian Haywood, Investment Strategy Advisor. Hey guys, and welcome.
Good to see everyone.
Yeah, thanks for having us.
Absolutely. So Mike and Brian are going to lend their expertise to answering our frequently asked questions today. And Mike and Brian, rather than introduce you the traditional way, because let's be honest, you're both kind of a really big deal with Buckingham and in the industry, we are going to put your bios in the chat box so everyone can review those. But I thought we'd start today just by asking you, what was your favorite moment or experience from 2024? So Brian, why don't you start for us?
Sure, happy to share. So this was kind of a family moment. So my wife has been an educator since 2010, and back in 2021, she decided she wanted to move from the classroom into administration. So went back to school, got the certification, and then for the last about 18 months, she had been job hunting while still teaching as well. And so finally this summer, she landed her dream role. So she's an assistant principal now here. We live in St. Louis, so at a high school here in St. Louis. So that was a really cool moment back in August when she finally got word that all the hard work had paid off, and she got that position. That was a really cool moment, and it was so great to see how happy she was because I know she put in a lot of work over the last 2.5, 3 years.
That's amazing. Well, congrats to your wife and your whole family. That's incredible. A
Thank you.
career change, a dream career. That's wonderful.
Mm.
And Mike, how about you?
That's a great way to start, Deanne. So I think mine would be I had a pretty significant milestone birthday this year, and I had knee surgery right before it, so really couldn't do much on my birthday. But during my kid spring break, we went on a family trip. I love to travel. I love to travel to Europe. when there's an opportunity. And so we went to Italy and spent, I think, 11 or 12 days. They had a long spring break. And we were in Rome, couple smaller towns in Tuscany, and then we were in Venice, and we were in Venice for Easter and went to Easter service at St. Mark's Basilica. So that's a really cool memory and a trip that hopefully the whole family will remember for a long time.
That's awesome. It's always fun to travel and make those moments and memories with family. So fantastic. And if any of those of you out there want to share your favorite moment of 2024, you had something really stellar, feel free to put it in the chat box. We'd love to hear about that as well. So aside from those wonderful things that happened in 2024, as we move into 2025, I think Buckingham has a really exciting announcement. So I'll let maybe Mike take that and share that with the group.
Sure, Dan. So we do have exciting news. We've been majority owned, our parent company, Focus Financial Partners, going back, I think, since 2007. And what they're doing, they have a strategy to integrate a lot of their firms, and so we will actually be going under the Focus umbrella. We'll have a name change to Focus Partners. So the great news for Elevate clients, there's nothing you need to do. Deanne and the advisor is not going to ask you for a signature or anything, but do want to give you a heads up. I think the name change is effective January 13th. And so most likely the first quarter statement, not your next statement, but the first quarter statement, and then some other materials where you see Buckingham branded, you will see Focus Partners going forward. Our leadership hasn't changed. The only thing I expect, Deanne talked about the resources and how we partner with Elevate, and I think this will give us the ability to just expand those resources, increase and enhance technology. So I think it'll be a good thing down the road, but not anything to do for Elevate clients, but something we are excited about.
Oh, it's so exciting. And I know that you guys have been under that in that Focus family for a long time now. And we've always enjoyed our relationship with Buckingham. And like Mike said, just to echo, nothing will change with us, nothing will change with our service team or our partners at Buckingham. And we're just excited that this will give us the availability to have more access to those tools and resources that we use to help you. So thank you, Mike. And we look forward to seeing that name change. If you get something on your statement and it says Focus, you'll know now who that is. It's the new name for Buckingham. So, all right. So let's get this party started, if you will. So what we're going to do is we're going to do this roundtable style, and we're going to pose some questions. But first, Brian is going to give us some comments, just a little bit of wrap up for 2025. So I'll pass the baton to you, Brian.
All right. Thank you so much. Let me share my screen because I do have some slides here. So can everybody see my screen okay?
I can see it.
Perfect. So as Deanne mentioned, I will give a brief kind of wrap up on where the markets are, at least through the end of November here. And then talk a little bit about actually, let me just skip forward here so you can see my agenda here. So give a brief market update, give an economic update, as I think that will shape a lot of what's going to happen in 2025. And then talk about Fed policy, as obviously the economic picture will probably drive a significant amount of the future Fed policy moving forward. So as far as a market update, it's been a really, really good year for markets as a whole, whether that be on the equity side or the fixed income side. So you can see here, the U.S. total stock market through November was up almost 28%. So very, very strong returns within the market as a whole. U.S. large value stocks trailed a little bit, but we're up about 23%. Small value up about 18%. So U.S. stocks did exceedingly well. International stocks trailed, but still had fairly strong positive returns. So international developed stocks up about 8%, developed value stocks about 9%, small value about 6%, and then EM stocks about 8%. So kind of a similar story we saw in 2023 with fairly good returns, with the U.S. still leading the way here. But there's not really much to complain about as far as equity returns in 2024. So far in December, it's been a little bit of rockier road as December hasn't been quite as good of a month, but still that shouldn't damper what has happened so far in 2024. Now moving over to the fixed income and alternatives. So fixed income also had fairly strong positive years. So the U.S. fixed income market as a whole was up about 3%. Intermediate treasuries basically up the same at 3%. And then inflation protected bonds were up about 3.5%. And a lot of this came from the fact that basically throughout all of the third quarter, we saw rates come down fairly significantly as the market was starting to price in the Fed starting to lower interest rates. And I'll get to Fed policy here in my next talking point. But that drove a lot of the returns as the fall in interest rates we saw in the third quarter of 2024. Looking at alternatives, so real estate has had a nice bounce back year. It's really gotten hammered over the last couple years, but it's really bounced back well with global real estate being up about 11%. And then we just like to track commodities as well as another asset class. While we don't specifically invest in those, we do like to keep track of that market, and commodities are up about 4% this year. Now, transitioning over to the economy, obviously, inflation is still one of the hottest topics out there in the economy. So what I've tracked here is the PCE inflation. And PCE, that's the Fed's preferred gauge of inflation as opposed to CPI. PCE takes into account changes in consumer behavior. So whereas CPI is a static basket, so the Fed likes to use the PCE measure a little bit more. And what I've tracked here are headline and core. So headline includes all asset classes within the PCE measure, and then core excludes more volatile categories like food and energy. So you can see, although inflation has come down fairly significantly from its highs in kind of mid 2022, both headline and core numbers are still above the Fed's 2% target rate. So, while the Fed has begun to lower interest rates, their job isn't done. They still have some work to do, and some would argue that the last kind of mile here tends to be the hardest. It's a lot easier to get inflation down from 6 and 7% rates, but it's really hard to kind of go that last mile and get it from roughly a 3% rate down to a 2% rate. So the Fed's still fighting that battle. Now, moving on to some other metrics, looking at CPI, again, that's kind of the number you'll see more in the mainstream press. You can see it's still above the Fed's 2% target as well, sitting at about 2.7%. So again, it's a little shown to be a little sticky there and a little bit harder to get below that 2% rate that the Fed is kind of uses as a target.
Brian, I
Now
think
go ahead, Mike.
sorry, I was just gonna. I don't think you have a slide on this, but the Fed's meeting today. What does the market have priced in now for expectations on rates? I guess over the next couple of days, but then going into 2025.
Hold that thought because I do have some slides here in a moment that will discuss that.
Thanks.
No problem. As far as the overall economy, is fairly healthy. We saw real GDP growth of about 2.8% in Q3. We got some decent retail sales data that came out actually just this morning that shows U.S. consumers are continuing to spend, and that's really the lifeblood of the U.S. economy or retail sales. Unemployment is still remaining quite low. It has ticked up a little bit over the past couple of months, but still, historically speaking, quite low at 4.2%. And job growth, although it has definitely in a little bit of a downward trend, it's still fairly positive. The most recent data, we got 227,000 job ads as in the month of November. So the U.S. economy is still holding up quite well. given everything that's going on with higher interest rates. Now, transitioning to Fed policy, and as Mike mentioned, we do have an upcoming Fed meeting. Well, they're meeting today. It's a 2-day meeting, but they'll do an announcement tomorrow in terms of the Fed funds target rate. And as of today, it sits at 4.5, a range of 4.5 to 4.75. It's basically 100% chance that they will lower it an additional 25 basis points tomorrow. So would expect it'd be a major shock if they didn't. So we're looking at essentially a Fed funds target rate of 4.25 to 4.5% once they make the announcement tomorrow. So you can see it here in that second bullet point. Will that remainder of the year, further 25 basis points by the end of the year? That's tomorrow's meeting. They do want to stress that they are quite data dependent. So they're saying, they're attentive to risks on both sides of the Fed's dual mandate. So as a reminder, the Fed's dual mandate is stable prices and low unemployment or maximizing employment. So they're gauging both there. So they're looking at all the latest data to decide what the next step is. Now, looking forward, as of the Fed's September meeting, they produce on a quarterly basis what they call their summary of economic projections, which is basically the Fed's forecast of what they think various economic metrics are going to be, including where they think the Fed funds target rate is going to be in the future. So this data here is about 3 months old. Unfortunately, the next data point isn't coming out until tomorrow. So, everybody in the market's going to be looking at it very closely to see how the data points have changed between September and tomorrow. And then obviously they'll be looking at Chairman Powell's press conference and going over his answers in his press conference very carefully. But based off of what the Fed was projecting in September, they're looking at effectively lowering the Fed funds target rate, essentially an additional roughly 100 basis points in 2025, and then about 50 basis points in further in 2026. So that's kind of the median for the Fed funds target rate at the end of 25, about 3.4 and 2.9 at the end of 26. Looking at Fed funds futures, which is a good gauge of what the market's expecting, the market's not quite pricing in as many cuts. And I think that's a function of we have seen inflation start to tick up a little bit, and we have also not seen a compelling slowdown in the economy. So there's really not a great reason for the Fed to be aggressive in terms of rate cuts because the economy is still on its feet. It's still doing quite well. So there's just not the impetus to lower rates more aggressively because they don't want to follow in the footsteps of Arthur Burns and the Fed from the 1970s, where you had high inflation. They started raising interest rates. We started seeing inflation come down, and they started cutting rates too soon. And we saw inflation pop back up in kind of the late 70s into the early 80s. And we had what we had with the Paul Volcker-led Fed, where they had to raise interest rates incredibly high and really effectively kind of kill off the economy in the early 80s to get inflation under control. That's exactly what they don't want to have happen here. So I think in 2025, now this is my own personal opinion, we'll see if it actually comes to fruition, but I think they're going to be a little bit more cautious. And I would not be surprised if in the summary of economic projections, you are going to see the Fed kind of take their foot off the gas a little bit as far as rate cuts go, and we might see a little bit more hawkish tone from the Fed. That's just my opinion. They could surprise me, but that's just kind of my thinking in terms of the future of Fed policy because we still have inflation that is still a decent amount above 2% and an economy that is still on pretty solid footing. So to me, there's just not a strong reason to really aggressively cut rates in 2025. So with that said, I will turn it back over to Deanne for questions.
Awesome. All right. Well, thank you, Brian. That gives us a really great baseline for the questions we're going to ask. And so what we've done is we've just taken what are our frequently asked questions that we hear from clients all the time, or things that we've heard this year. And we're going to pitch those to you team member by team member. So I'm the lucky one who gets to go first. And I think what we've heard all year long is election, 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 right? Until the election came and went. And now that that election is over, what do you think we can expect regarding policy changes?
Yeah, great question. Well, the first thing I would say is, everything all the information that's out there has kind of been priced into markets. We saw it really kind of a little bit in real time. If you remember the day after the election, when it was clear that Trump had won, and wasn't 100% sure, but it looked like the Republicans control both the House and the Senate. We saw a nice little pop in the equity markets here in the U.S. And I think that was a healthy amount of that kind of information being priced in. So as far as the potential Trump policies, first one, obviously, probably the one that is been talked about the most are the potential for higher tariffs on specifically China as well as some other countries. Haven't seen anything officially announced. So we'll see what tariffs or if there are any, actually imposed. Now, as far as my thoughts on it, I think tariffs are not necessarily something that he wants to put in place, but more of I am going to use this as kind of a bargaining tool to potentially get better trade deals or get some of these nations to change their trade policies. So, could some of these be enacted? They certainly could, but if China would agree to whatever changes he wants them to make, or maybe Canada or whoever it might be, we might not see them put in place. But obviously, if tariffs are put in place, that will be a short-term hit to the economy. Is obviously tariffs are effectively a tax on consumers. So we would expect wherever those tariffs are put in place, probably some higher costs there. Um, Taxes also, he has said recently he would like to lower taxes. I haven't seen any official policies put out there, so we'll see what we're looking at there. Other thing, deregulation. I think there's going to be a big push to deregulate certain areas of the economy, which I think could be good for economic growth moving forward if we can remove a lot of the red tape that's currently out there, whether that be in the energy sector or some other areas. I think that could be positive for GDP growth. Kind of in the same vein, we have what's been termed DOGE, Department of Government Efficiency. We'll see what recommendations come out of that group. That's the group led by Musk and Ramaswamy. I believe they're kind of be looking at the federal bureaucracy and see what potential efficiencies can be there, whether that be job cuts, technology resources that might be upgraded there. So that could potentially be a boon to the economy. And then last but certainly not least, obviously immigration policy. There's been a lot of rhetoric out there as far as what he is and his administration is going to try and do as far as either um, removing illegal immigrants from the country and changing immigration policy. So we'll see what could come there. Obviously, if there's a big hit to illegal immigration, obviously those are some industries have heavy ties to migrants. So we'll see what those industries how they're impacted, if at all. He's said a lot of things. We'll see if he can actually do these things. As obviously we all know, presidential candidates tend to make a lot of promises. Sometimes they deliver on them, and sometimes they don't. But I would say if you're looking at kind of a top five, I would say those would be the ones to look out for.
Good stuff, Brian. Thank you for that. Now we'll pass the baton over to our director of investment policy, Rob Fazekas, who has the next question.
All right, thanks, Dan. So we've had two back-to-back years of very strong stock market performance, especially in the US. And I know that some clients are asking if stocks might be getting a little expensive. And so I was just wondering if you could give us your take on how market valuations are looking today.
Yeah, great question. I have a slide on this, so let me actually share that. So what we're looking at right here, what I've graphed is what's known as the Shiller CAPE 10. It stands for the Shiller Cyclically Adjusted Price Earnings Ratio, and essentially looks at kind of rolling 10-year averages of what US international developed and EM stocks, what their price earnings ratio is. And essentially what that is the amount you're paying for each dollar of earnings. So this particular data, in the US, it goes back farther than 96, but 96 is the longest period we have for all three of these asset classes here. So you can see over this entire time period in the US, the average PE ratio has been about 28.6. In the international developed market, it's been about 21.5. And in the EM market, it's been about 18.2. Now, as we sit today, you can see US stocks are sitting at about 36.6. So they're a decent amount above kind of their historical average over the last roughly 30 years. International developed stocks are higher, but not nearly as high relative to their average as the US. And then EM is actually right now lower than its average over this time period. So what does that mean? Well, when markets tend to be higher value, more highly valued than they historically have been, that typically means over a longer term, you should expect lower expected returns moving forward. So I would say looking at where valuations are right here, I would expect lower returns within the US. In the international markets, I'd expect probably average returns. And then in the EM markets, higher than average returns based off of valuation. So yes, in short, in the US market, definitely stocks are more expensive than they historically can be. And just to give you an idea, just to kind of show you how nuts kind of US stock prices have been over the last 15 years, if you look back to kind of the start of 2010, the CAPE 10 for US stocks was 19.5 and it's grown to 36.6. Whereas international is up a little bit, but not drastically. And actually EM has actually gone down. So yeah, it's been a really, really good ride for US stocks, but I would expect moving forward over the longer term them to have lower expected returns. But that doesn't necessarily mean in the short term you can't continue to have them go up in price. Now, with that said, obviously a lot of the U.S. returns have kind of been dominated by these Mag 7, cohort. So if you took those out of kind of the U.S. valuations, U.S. valuations definitely would be lower. They'd still be above average, not quite as high as they are because the Mag 7 is kind of really shaded that specifically on the backs of kind of NVIDIA, Apple, and Microsoft recently.
Awesome. All right, our next question comes from advisor Clark Holt.
Thanks, Deanne, and thanks, Brian and Mike, for taking time to join us today. So my question is, and a question that I've received is, how will geopolitical tensions, for example, U.S.-China relations, ongoing conflicts around the world, impact global trade and investment markets?
Yeah, great question. And I like this. I probably should have just kept my screen up here because I do have another slide to share here. We really like this slide. And as you mentioned, obviously there's tons of geopolitical and trade issues floating out there, whether that be trade issues with China. Obviously, you've got China and their kind of Cold War with Taiwan, as Taiwan produces some of the most some of the best semiconductors out there that a lot of not only U.S. manufacturers but U.S. defense systems rely upon. Obviously, you've got the conflict raging still in Ukraine. You've got the issues in the Middle East with Israel's war in Gaza and Lebanon, and then we just had recently the Assad regime collapse in Syria. So there's a lot of political instability there. But you can see we charted the MSCI World Index back to 1970 and noted a number of the various, whether that be economic crises. You can see some geopolitical events, Iraq invading Kuwait to start the Gulf War in the early 90s. But you can see universally, even throughout all these various, whether it be political or economic crises, the market tends to go up over time. So the thing I want to stress is everything that is known today is priced into the market. And the things that are going to change the market are by definition unknown or non-predictable events, things you can't get ahead of because you don't know they're going to happen. So our advice is you're likely going to lose more money in the long run trying to get out in front of potential events than just living through them, because there's no red light that tells you, okay, now's the time to get out of the market. And also on the flip side, there's no green light that tells you, hey, risk on, everything's good to get back in. So, over the long term, despite all these various different political and economic events, the market tends to go up over the long term. So those that are patient and stay in the market are those that benefit from the market's long-term returns. So in short, try not to make any changes. Don't shift your tactical approach or your investments based off of potential things. Stick with it for the long term, as a long term patient investors are going to be rewarded.
Lots of good advice and lessons there. So time in the market versus timing the market. For the next question, we'll shift back to Rob.
Okay. So as advisors, we've been planning for the end of the Tax Cuts and Jobs Act. The end of it was scheduled for the end of 2025. Now with the election results in November, it looks very likely that some of those parameters of that law will likely be extended for several years. And so I was just wondering if you could speak, to the perspective of maybe a client who's got accounts that are both retirement accounts and non-retirement accounts. If you could talk about asset positioning for someone who'd really like to save taxes this year and also into the future for themselves and their heirs.
Thanks, Rob. Great question, and I can take that one. It is no guarantees, but it is probably our viewpoint too at this point that the two big aspects of the Tax Cut and Jobs Act, we were going to have the estate exemptions essentially cut in half when that expired at the end of next year, and then income tax rates would go back up, and we think it's likely that both of those pieces are not impacted. So that is a good thing for most of us. And as Brian mentioned, the administration or new administration is even talking about lowering rates. From an asset location perspective, and one of the things we do at Buckingham, we work with the Elevate team. But for most of you, when you have a portfolio, we have an asset location scoring system where we're going to look at the different investments that you have and put those into the bucket that's going to be most tax efficient long term. As an example of that, in an IRA account, you may not see high growth asset classes, because what we want to do there is, when you get to that RMD age, we want to minimize growth in that IRA account. So the team at Buckingham, we have an advanced planning team. They work with Brian and our investment team. We continue to refine and enhance that asset location scoring system. But the big thing I would convey here is that you have a team of experts that is working with the advisory team at Elevate to make sure that we are enhancing your after-tax returns. So what you can actually take home. I will say one asset class in particular, maybe two, where there's a little bit of an impact. REITs, most of the Elevate clients, I believe, have a real estate investment trust fund, and there is a deduction for pass-through entities that is in the act. I think it's a 20% deduction, so it makes REITs a little more tax friendly than they were, and so that makes it more likely you could see a REIT account in a traditional brokerage account, so a taxable account. And then the one other one would be municipal bonds. If rates continue to stay down, municipal bonds for some would be a little less attractive. But again, that's one where our investment team is going to look at federal tax rates, state tax rates, and then look for the highest after-tax return.
Yeah, where you hold assets matter, in which type of account. And so I think that that's the concept that Mike is doing such a great job of explaining there. And so I think it's just a matter of that is something that you have control over, right? It's something that out of all the things in this world that we don't control, but something we can control is what type of assets we hold in what accounts. And now that we have a better idea of what's going to happen in tax cuts or with the landscape of taxes going forward, we can continue to work with Buckingham's team to make sure that we're doing that for our clients. So great answer, Mike, and thank you for that. For the next question, we will go to our advanced planning coordinator, Dee Dee Bloom.
Thank you. Yes, and Mike, you mentioned your advanced planning team. And when we talk to clients very frequently, we talk about long-term care planning and what they should anticipate paying for and how they can plan for that. And we very frequently refer them to other insurance planners to get quotes and things like that for long-term care insurance, but the quotes sometimes come back very cost prohibitive. So I was just kind of curious if there's other strategies or if are there reverse mortgages or anything like that that your team is recommending for clients who need to prepare for that?
So that's a great question, and it's a real challenge, Dee Dee. There were a lot more long-term care providers in the marketplace 10 years ago, and as boomers have aged, and healthcare costs, as we all know, have just dramatically gone up, many of these providers have pulled out of the marketplace. One of the things with long-term care insurance, like many kinds of insurance, is you may be paying for something that you never need. And I think that's a challenge for some clients. But with that being said, healthcare is probably the biggest wild card in a client's financial plan. So that's definitely something that anyone approaching retirement wants to sit down with their Elevate advisor and make sure they come up with the best game plan. A couple things that we have seen in some cases, a reverse mortgage can make sense to help fund it. So that is one solution, not going into the investment account, but actually the equity in your home. And then the second one that I do see from time to time is permanent insurance products that have a long-term care wrapper with the insurance. And the benefit there is, look, the insurance companies, they're going to stack the odds in their favor. But in that scenario, if you do not use the long-term care benefits, your heirs would receive a death benefit when you pass along. So again, the insurance company's going to tilt the odds in their favor. But if you don't use the long-term care, at least your heirs are getting a benefit. So that's a couple of the solutions that you may look at.
And
Perfect. Thank you.
a really good point that healthcare in retirement is the wild card at some times. And so I think having a plan for it is really important, and making sure that you're addressing that with your advisor if you haven't already. It's one of the things that at Elevate we always build into our financial goal plan. So just make sure that you got a plan for that wild card of healthcare. For the next question, we will go to our advisor associate, Preston Wilkie.
Hey guys, thanks for joining us. My question is, some people have expressed concerns about how the national debt is at an all-time high. What are your thoughts on how the deficit may affect the economy overall and as well as the market?
Yeah, great question on that. Obviously, it is definitely concerning, given the significant increase in the national debt that we've seen really just in the past 5 to 10 years. Now, some of the things that will help a little bit in the short term is if rates come down, that will certainly help a bit as financing costs decrease. But certainly there will have to be a reckoning at some point in the future. The issue really comes down to, on Capitol Hill, you hear a lot of the discussions about discretionary spending, defense spending, these types of things. That really only makes up a very small percentage of total government expenditures. The major drivers of our national debt are the entitlement programs that we're running, specifically Social Security, Medicare, these types of programs. So, they probably will have to be addressed at some point. Now, there's two things we can kind of do to fix this. We can try and cut costs within those programs to a degree. Don't know how feasible that is from a political perspective, is obviously touching any of those programs is kind of a political third rail. Regardless of what side of the political aisle you're on, nobody really wants to touch those. The other one is trying to grow your way out of this. And I feel like that's where the incoming Trump administration is trying to go in terms of reducing, deregulating certain areas of the economy, looking at government efficiency and seeing what bloat there is there to try and grow the economy faster, and then potentially cut out some waste within the federal government. So hopefully those will make some differences there. But certainly that is something to be aware of, and certainly the larger that deficit gets, at some point you're likely going to see, probably going to lead to higher long-term rates, as it's going to be, investors are going to demand more yield to own U.S. debt. So that definitely can crowd out some of the private investment within the economy. But certainly that's something to keep an eye on. But in the short term, don't see it as a major issue in the short term, but certainly something to keep an eye on the long term. But it seems to be kind of the plan right now, is a little bit kick the can down the road until it becomes a more significant issue. When that does, I don't know, because our economy is still by far and away the biggest, and there are certainly other countries in worse fiscal situations than we are. So there doesn't seem to be kind of the 5-alarm fire to kind of make changes at the moment. But obviously we'll continue to watch it. But at some point in the future, there will have to be some kind of reckoning.
Right. Thank you for that, Brian. I know that's something a lot of our clients ask us about. And this entire webinar, we've been saying Brian, 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 and talking about Brian Haywood. And now for our last question of our roundtable, I will pass the torch to our own Brian Rosso, who will wrap up our roundtable questions. Brian, take it away.
Thanks, Dan. So, you know, like Dan said, we've talked a lot, we've covered a lot: national debt, taxes, inflation, tariffs, you name it. I mean, there's basically an unlimited number of variables and kind of information that goes into what affects financial markets. But given what's going on today in today's world, what should clients take away from today, and what changes, if any, should they make?
In short, I would say the plan, the well thought out plan that your Elevate advisor has curated for you, stick to that. You know, the things that should get you to change that plan should be changes in your goals, changes within, you know, your health, you know, changes like that are the things that should drive you to make changes within your portfolio. You shouldn't make changes based off of things going on in the market, things going on politically. I kind of alluded to it in that slide I showed earlier. In general, markets go up, and so patient investors are rewarded. You know, the evidence is very clear that trying to time markets and make tactical changes based off of expected changes in, you know, global markets, in political spheres is a loser's game. S&P puts out a great study every year. It's called the S&P Index versus Act study, and it looks at within active funds how many active funds actually beat their benchmark. So how many of these tactical decisions actually pay off? And the vast majority of the time, the vast majority of active managers underperform their benchmarks after taxes. That tells me that trying to time markets is only going to cost you money in the long run. So stick to your well thought out plan. Keep the conversation open with your advisor. Keep them abreast on any changes in your goals, any changes in your lifestyle, any changes in your health. And those are the things that are should be the driving force behind changes within your plan, not market movements, not political events. So in short, stick to your plan, and conversations with your advisor will ferret out any changes you might need to make in the future.
Well, obviously, Brian, we couldn't agree more. You know, life dictates the plan, not markets or forces outside of our control. And we often say, one of my mantras, of course, and what for all of us at Elevate, is focus on what you can control. And so that's what we're here to do with our clients and for our clients at Elevate, is help you focus on what you can control and stick with the plan that is dictated by what's happening with you and with your life. So I want to thank Brian and Mike both, and our Elevate team for joining us today. And I'm going to make one last pass of the mic, if you will, to our marketing coordinator, Betsy Kenyon, who is always so wonderful to coordinate these monthly webinars for us. And she is going to wrap up today. So Betsy, the floor is yours.
Thank you. And we do have a question in our Q&A box. So it seems like Bitcoin and cryptocurrency don't want to seem to go away. You've got Warren Buffett on one hand with his opinion on it. Then you have Trump, who just mentions it and sends it soaring. So now what? What do you guys think about Bitcoin and crypto?
You want to start with that one? I can add a
Yeah.
few thoughts.
So we've obviously looked at crypto quite a bit, given you know, all the news out there regarding Bitcoin, and you know, just recently went over 100,000 mark recently. You know, in looking at it, we're just not clear what the investment thesis is there, because it doesn't produce income. It's not a claim on, you know, long-term cash flows of an organization. It's just a currency. Just like we don't just buy euros as an investment, or buy Japanese yen. You know, I'm just not sure. We're just not sure what the long-term investment thesis is there. And also, although Bitcoin seems to be the leading cryptocurrency at the moment, is that going to be the leading cryptocurrency over the long term? As obviously there's other cryptocurrencies out there like Ethereum and some others. So, are one of those going to take over? I like to use this analogy. This was when I was quite a bit younger. There was two competing social networks. There was MySpace and there was Facebook. And you could argue when I first got on social media in kind of 2005, MySpace was bigger than Facebook. Now you ask the average person what MySpace is, and they will look at you like you got three heads. They have no idea what MySpace is. And obviously, we all know what happened with Facebook and how that took over and the network effect there. So, is Bitcoin going to be the number one cryptocurrency and going to continue to go up in value? I don't know. Now, with that said, for those clients that do want to allocate to Bitcoin, we would say if you're going to sin a little bit. And I wouldn't allocate more than maybe 1 or 2% of your overall allocation to that. If you're just dead set, I do want exposure to this asset class. Now the good thing is you can get exposure to it without buying Bitcoin directly. So now there's spot ETF, Bitcoin ETFs out there. So if you do want to get exposure to it, I would recommend going that route, as you can get exposure very cheaply and you don't have to worry about storing your Bitcoin and hanging on to your pass keys. I know I've seen a couple stories out there about people sitting on rather large Bitcoin allocations and they've lost their pass key. And I think after so many failed attempts, you're kind of out of luck there. So if you do an exposure, make it small and do it through the ETF wrapper.
That is great
And
advice.
that, Betsy, I would think of it as your play money, and if it is a currency, it's a very, very volatile currency. With all that being said, I think the blockchain technology, that's real, that's here to stay. So, yeah, as far as an actual allocation to your portfolio, that's not where we see it at this point.
Thank you both for answering that question. We really appreciate it. And we really appreciate both of your time today, as well as everybody on our team. We're looking forward to a great 2025 with all of you, our wonderful clients, helping us and supporting us. And we're happy to be here to help support you with the help of Buckingham. I do want to share my screen real quick and show you, as you all know, this is our website. If you want to look up any of our resources, we have wonderful blogs, newsletters, some educational articles here for you. And then you can also just go to attend webinars and you can see everything we've got teed up for 2025 here. Also, this will be on our YouTube channel later today. So I will direct you to just go to Elevate Wealth Advisory in Athens, Georgia. Just type that into Elevate and you can hit subscribe. You'll get notified every time we put up a new video, and you can share this with any friends or family who might not have been able to join us today. We also would love to hear from you. So if you have ideas for webinars or blog posts or our YouTube weekly video series, which is Elevate Wealth, please email me, marketing@elevate-wealth.com. We love our input from our clients. We thrive on that. We want to make sure we're delivering what you need from us. So with that being said, I hope everyone has a wonderful holiday and a safe and happy 2025. Thank you all. Bye, everybody. Thanks. Have a great day.